work I do here. Support it by subscribing and commenting. That one small move helps more than you think. All right. Today we're going to break down the flash crash behavior you just saw, the rumor that a major government mint may pause silver sales, why the gold to silver ratio matters more than most people realize, and the strange gap that keeps showing up between Asian silver pricing and US pricing. But there are two big reasons you need to stay to the end. First, a close friend called me last night and again this morning in full panic, trying to chase silver at the worst possible moment. I walked him through a disciplined way to buy without turning his money into a casino bet, and I'm going to show you exactly how we did it. Second, I'm going to tell you what I think actually caused today's chaos, why the official explanations are mostly noise, and why this isn't just about metals or crypto or stocks. It's about the plumbing under the entire financial house. And that part is where people either wake up or they get wiped out. Also, check the description when you're done with the video. I put bonus links down there, including a premium WhatsApp channel link and a channel membership join link, so you can keep up with alerts and extra content without hunting for it. Okay, let's talk about the move everyone felt. A viral post made the rounds claiming this was once-in-a-decade behavior. The math they threw around was dramatic. Within about an hour, trillions in paper value were erased across a basket of assets. Gold had a sharp drop. Silver dropped even harder. Major stock indexes slid. Crypto bled. Whether you love those numbers or hate them, the bigger point is what your eyes already saw on the chart, a synchronized air pocket. And here's the first cliffhanger you need to lock in. When many assets fall together in a tight window, that's usually not millions of humans deciding the same thing at the same time. It's machinery, it's positioning, it's force selling, and the why behind that matters more than the candles themselves. Now, right as everyone was freaking out, another post started spreading. A claim that a major government mint would stop selling silver products within the next day. No mint named, no official statement, just a trust me vibe. Do I believe every rumor that hits the internet? No, and you shouldn't either. But I do pay attention to rumors like that for one reason. Rumors don't have to be true to move a market. They just have to be believed by enough people for long enough to trigger a chain reaction. So keep that rumor in your pocket, not as gospel, as a possible match. Because if physical supply tightens while paper volatility spikes, you get a dangerous cocktail. Higher premiums, delayed delivery, and people overpaying at exactly the wrong time. And if you're new here, let me say this clearly. Physical buying is not the same as trading a ticker on an app. When you buy physical, you're dealing with shipping, verification, inventory, and real-world friction. That friction is why physical can stay tight even when paper price is having a tantrum. Now, another angle people used today was the crisis comparison gam. You've seen it before. Someone posts a chart that says, back in the financial crisis, gold moved like this. During the pandemic, it moved like that. And now look at this move, so something massive is coming. Here's my take. Yes, big gold moves often show up around big trust events, banking stress, policy pivots, currency fears. But the mistake is thinking the move itself predicts one specific event. Markets don't work like a fortune cookie. Sometimes the move is the event. Sometimes the move is front-running the event. And sometimes the move is simply money looking for a safer corner in a burning building. And that brings us to the loudest phrase being tossed around today, forced cash settlement. Some people are claiming that when demand for physical delivery overwhelms what's available in vaults, certain exchanges can declare an emergency and cash settle contracts instead of delivering metal. Let me translate this into normal language. If you bought a contract expecting to receive metal, and you're told, here's cash instead, and by the way, we're deciding the price, you didn't get what you thought you bought. You held a promise, and the promise just changed. Now, does that happen tomorrow? I'm not here to predict dates, but you should understand the incentive structure. If too many people demand delivery at once, the system's first priority is not your satisfaction. It's the system's survival. Here's the counterpoint, though, because this matters for your decision-making. Cash settlement isn't always the apocalypse people make it sound like. It can be a pressure valve. It can also be a legal battlefield. And it can backfire by destroying trust and pushing more people into physical ownership outside the paper system. So if you're rooting for a gotcha moment where an exchange collapses on camera, you might miss the real story. The slow drift of confidence out of paper claims and into tangible assets. That drift doesn't trend on social media the way a crash does, but it changes everything. And speaking of social media, we had the usual celebrity signal today too. A famous TV market guy popped up early saying gold was unwinding and silver looked overvalued. Then the market bounced, and people immediately started joking, If he says sell, I should buy. You know the routine. Here's the reality. Whether he's right or wrong doesn't matter as much as the role these voices play. Their job is to make you feel like the move is obvious after it happens, to turn uncertainty into a story. And stories are powerful because they keep you from doing math. Now, the what caused it conversation is where things get interesting. You'll hear 1,000 explanations. One big entity dumped crypto, a report leaked, a geopolitical headline, a speech, a hedge fund blew up, a broker tightened margin, an options dealer hedged, and on and on. Most of that is white noise. The most plausible core driver behind moves like today is this: automated strategies reacting to the same triggers at the same time. A keyword hits, a volatility threshold gets tagged, liquidity thins, one algorithm sells. That selling moves price. Another algorithm reads that move as confirmation and sells too. A third one has risk limits and is forced to cut. Suddenly a small push turns into an avalanche. And here's the part almost nobody says out loud. These systems don't care what the asset is. They care what the model says. If the model screams de-risk, it sells gold, silver, stocks, and crypto all in the same breath. That's why it feels like the whole world punched it once. I actually called a friend of mine who's been trading and managing risk for decades, and I asked him, "What's your cleanest explanation?" He said, "People are hunting for a single headline, but the real cause is the feedback loop. One machine sells, it triggers another machine, and pretty soon the market is running on autopilot." Then he added something that stuck with me. On days like this, the most dangerous thing is the story you tell yourself after, because if you blame the wrong thing, you'll position wrong for the next move. That's the key, because the next move is already being set up while people are arguing about the last one. Now, remember that central banker talking about AI data centers like it's free money falling from the sky? My buddy laughed at that. He said, "You know what nobody wants to admit? A lot of these data center projects don't have clean returns yet. They're betting on future demand, and the grid is the bottleneck. If power costs spike, those margins get ugly." And he's not wrong to raise the question. Recent winter stress on the grid showed how tight power systems can get, and data center-heavy regions can see prices jump sharply during peak events. So when you hear AI build-out is helping, also hear AI build-out is pulling forward massive spending, and somebody has to finance it. And when financing gets tight, you get volatility. Now, before we get into my friend's silver purchase, let me hit one more myth that blew up in the comments today. People were saying, this must be a force majeure event. Insurance will cover it. That's not how this works. Force majeure is supposed to be about acts beyond human control. A hurricane, an earthquake, a war shutting down shipping lanes. A shortage created by too many paper claims chasing too little metal is not an act of God. It's a design issue. And if a system tried to slap a force majeure label on something that's basically self-inflicted, you'd be looking at lawyers arguing for years and insurers doing everything possible to avoid paying. That's not drama, that's contract reality. Okay, now let's ground this in what you can actually control, because doom scrolling doesn't pay your bills. My friend called me last night, emotional, excited, scared, all at once. He wanted to buy a big chunk of silver immediately because he saw the chart moving and he didn't want to miss the next leg. He said something like, "If it hits the next big number, I'll just flip it." And I stopped him. Because if your plan is to buy in a panic and sell in a panic, the market will eat you alive. You're not investing, you're donating. So here's how I walked him through it, and you can copy this process regardless of whether you're buying metal, a stock, or anything else. Step 1. Understand the difference between the quoted price and the price you actually pay. Most people see a spot price and think that's what they'll pay. It's not. There's the price on the screen, and then there's your all-in cost. When you buy physical metal, you usually pay a premium above spot. That premium can be small when markets are calm, and it can explode when everyone rushes in at once. Premiums are basically the market's way of saying, we can't instantly turn your clicks into real bars. So I told him, before you buy anything, spend one night just watching premiums. Watch how they widen when prices rip. Watch how they narrow when fear hits. Get familiar with the rhythm, because the rhythm matters. Step 2. Never commit your full amount on your first click. If you're right, you'll win. If you're wrong, you still have ammo. This one rule saves people from the "I bought the top and now I hate the asset forever" cycle. Step 3. Decide your purpose before you buy. Are you buying physical as a long-term store of value? Then you should be mentally prepared to hold through ugly weeks. Are you buying to trade? Then don't pretend it's a forever hold when the chart turns red. That's how people get trapped. Now this morning he called again, even more intense. Price was higher overnight and he was convinced it could only go up. He wanted to slam the buy button for a big amount. I told him, "You don't buy parabolic candles, you buy pullbacks. And if you can't handle pullbacks, you're buying too big." We agreed on a simple rule: cut the first buy in half. Not because I'm afraid of silver, because discipline beats ego. Then the market did what it did. The drop hit. And I'm not going to pretend I predicted a flash crash. Nobody consistently predicts that. What you can do is prepare for it. When price started falling hard, I told him to sit tight and not catch a falling knife. We watched for stabilization. Not the exact bottom, stabilization. Here's what stabilization looks like in real time. The speed of the drop slows, price starts chopping, and the bounces stop making lower lows immediately. It's messy. It never feels safe. But it's better than chasing. When we saw that chop, we picked a level that was meaningfully lower than his emotional entry, but not so low that he'd freeze and do nothing. That's a key point. The perfect price is worthless if you never act. He bought a smaller amount first. Then we planned a second buy only if price dipped again. If price ran, we'd already be in. If price dipped, we'd average in. That's how you avoid the all-in at the top disaster. Now here's the part that really helped him sleep. We also chose a product type that usually carries a lower premium per ounce than smaller pieces. Bigger bars often mean lower premium, even though they're less flexible to sell in tiny chunks later. That trade-off is real. And before anyone freaks out about where you buy, I don't care if it's a giant marketplace, a local shop, or a dealer online. I care about three things. 1, is the metal authentic? 2, will it actually show up? 3, if something goes wrong, do you have a clean path to dispute and recover funds? That's it. Loyalty doesn't protect your money. Process does. Now, let me give you a practical checklist for the next time a mint shutdown rumor hits your feed, because this is where scams and bad decisions thrive. First, separate spot move from supply move. A spot move is just price changing on a screen. A supply move is when real products disappear, lead times extend, and premiums jump even if spot is flat. If you're seeing only spot volatility, that's a trading problem. If you're seeing inventory vanish, that's a supply chain problem. Second, watch the premium curve, not just one premium. Coins, small bars, and big bars behave differently. When panic buying hits, the smallest, most recognizable items usually get cleaned out first, and their premiums can explode. That doesn't mean silver is worth more in some mystical sense. It means convenience is being priced in. Third, don't let scarcity force you into a bad counterparty. When people get emotional, they'll buy from anyone with a flashy listing and a fake review count. Your goal is boring reliability. If you can't verify the seller's track record, or you can't verify the dispute process, you're gambling with more than price. You're gambling with delivery. Fourth, if you're building a long-term position, think about exit friction now, not later. A massive bar can be cheaper per ounce, but it's harder to sell in small increments. Smaller pieces are more flexible, but you pay for that flexibility. There's no perfect choice, only a choice that matches your situation. And fifth, remember this. The point of owning physical is to reduce reliance on promises. That's why I'm always more interested in real-world behavior, premiums, inventories, delivery times, than I am in someone's dram attic post. One more fresh piece of context before we move on. A lot of the money that swings markets doesn't care about metal at all. It cares about liquidity and collateral. Big pools of capital still hold government bonds as core collateral, even while they publicly complain about debt. That tension is exactly why markets can look calm for weeks and then snap in an hour. You'll see it again, and when it happens, the people with a plan will treat it like a clearance sale, while the people without a plan will treat it like the end of the world. So here's my promise. In the next video, I'm going to map out 3 telltale signals that usually appear before the next wave of volatility. Signals you can spot without fancy software or insider access. If you can read those signals, you don't have to guess bottoms or tops. You just have to avoid the dumb mistakes. But for now, take today's lesson and apply it immediately. Decide your maximum position size, decide your buying schedule, and write it down. Because the market only feels fair when you're prepared before emotions rewrite your logic. Write it down, stick to it, and let the math outrun your fear. Even after buying the dip, his break-even wasn't the chart price. It was chart price plus premium. That's the part most beginners miss. If you buy physical, you should think in 2 prices, the market price and your all-in price. When you understand that, you stop obsessing over every $1 candle and you start focusing on your true cost basis. If you're successful, share your success story in the comments so others can stay motivated. Now, I want to pivot to the international angle because this is where silver gets weird. There has been a recurring gap between silver pricing in major Asian trading hubs and what people see in the US market. Sometimes it's small, sometimes it's glaring. When the gap grows, it tells you something important. Physical demand and local supply conditions can detach from paper pricing for stretches of time. That doesn't mean the paper market doesn't matter. It means paper is a reference point, not the whole truth. And if you're wondering why foreigners might hunt for US-sourced silver products, it's because arbitrage is real. If one region prices metal higher than another, someone will try to buy from the cheaper pool and sell into the expensive one. That's not conspiracy. That's capitalism. Now, the next piece is the gold to silver ratio, and I want you to actually understand why it matters. The ratio is just how many ounces of silver it takes to equal 1 ounce of gold in value. Historically, it's swung wildly. In modern decades, it's often lived around the mid-60s, but it can spike hard in panic, and it can compress during speculative silver runs. During the pandemic panic, that ratio blew out to around 125 at the extreme. That was the market screaming, "I trust gold more than everything right now." Back in the 2011 silver peak, the ratio was far lower, roughly in the low 30s, because silver was the crowded trade. More recently, the ratio has been hovering in the high 40s to around 50, which is a totally different regime. And here's the cliffhanger. When the ratio moves, it's not just telling you about metals, it's telling you about fear, liquidity, and which side of the trade is crowded. Now, let's talk about forecasts without worshiping them. You saw the headlines. One giant bank talking about gold pushing toward an